Well, even as headlines out of Europe dominate the markets, our first guest says the region's debt crisis is just a distraction. Joining us now is Keith Springer, president of Springer Financial Advisors. Keith, the distraction maybe is the kindest word that you have for it, but it's certainly moving the markets. So how do we tease apart this whole European crisis and then figure out how to invest our money?
Well, the biggest thing we have to realize is what the market likes new news, Shibani. And although these are definitely issues, this is actually the Goliath I talk about in the Facing Goliath in the book. This is an issue that's going to come back and bite us down the road, no question about it. But the market likes new news. The market already knows about what's happening in Europe. It's going to be a problem, but it's waiting for newer news. It's waiting for a simple resolution, even though it's going to be a Band-Aid. I think the market's ready to go up from here, not for a long period, not for the beginning of a new bull market or anything, but I think we're going to have a couple of strong months. You can see it by the fact that we're not declining on additional bad news. We had some bad news this morning on Italian bonds. Spanish bonds look a little bit bad. The market could have been down 300, 400, 500 points maybe 3 or 4 months ago. It's absorbing the bad news. We've got a number of good things out there. We've got negative investor sentiment, which is positive. Earnings were phenomenal. We've got very cheap interest rates and the QE mini-me, the continuation. So there's some positives out there, at least in the short term, for investors.
Let's get back to that QE mini-me concept that you just brought up here. What do you mean by that? Because I know that you believe that this mini-me QE quantitative easing could help get us out of a recession. I'm not seeing evidence to prove that, though.
Not get us out of a recession, keep us from going back into one. The fact that they're absorbing and reinvesting the bonds, the proceeds from maturing bonds, the interest from additional bonds, that's in a sense another quantitative easing program, not as big as the last big program, but it's a smaller one. It's why I call it QE mini-me. We've also got low interest rates for 2 more years. It's going to be most likely a slog through the mud economy, not anywhere robust. I'm not looking for big growth, but it's enough to keep us out of a recession. 1.5%, maybe 2% growth in GDP. Certainly anemic, not great, but it'll keep us out of the real abyss that I think many investors are worried about right now.
Keith, let's talk about some of your do's and don'ts. One of the things you talk about is not trying to time or outsmart the stock market. Does that mean that someone's always fully invested? How do you go around that? And really, it's a temptation that I think is hard to elude anyone, especially even professionals.
Well, that is the hard part, Charles. And the idea when you want to make sure that you're tactical, not buy and hold, or what I like to call buy and hope. You've got to be tactical in this market. You've got to take advantage of what the market gives you. Right now, the opportunities, the sweet spot, I like to call it, is in income and dividends. What we're doing for our clients is finding corporate bonds. They're tremendous yields right now, 8, 9, 10%. MLPs, preferred stocks. There's a lot of stocks out there that are yielding 8, 9, 10% and higher. That's the area you want to be in, because if the market is flat, for instance, the market just crossed where it was, 13 years ago. If you've been in just a simple growth investor, you've barely broken even, lost money to inflation over 10 years. Income and dividends will give you a better return in a flat or down market. It'll give you plenty of upside in a good market, and it'll get rid of a lot of those heart attacks and sleepless nights at the same time.
Keith, we have just a minute here. Before I let you go, I want to bring out two of the picks that you brought on with us at the end of October. One of them made you some money, and another one of them lost you some money if you followed your advice. Let's walk through your picks and why you're still behind them right now.
Mm-hmm. Well, Terra Nitrogen, I'm not sure exactly which ones, but Terra Nitrogen is one that I'm very bullish on. Agricultural products, fertilizer. We've got to remember the world is modernizing. The world is the higher and higher levels of GDP amongst the emerging countries, and there's a direct correlation between caloric intake and wealth. And as the world gains more wealth, people demand more food, better food. They demand more meat. Terra Nitrogen is in that sector, but it also has a nice 9% plus yield, which I really like. Legacy, I think, is a great one. It's an MLP, oil and gas. It's an MLP, so it has some tax advantages to it. I think it's very attractive. I'm also a big believer in the demographics. I think the aging population is going to put a lot of strain on the healthcare and medical system. I like healthcare properties. They focus on senior health cares, dialysis centers, basically an aging population. 78 million baby boomers are going to need these services. That's getting us 5, 6% yields plus some upside. So again, finding that sweet spot, that's what we like to do for our clients. Not, basically get equity returns without the equity risk. and I think you get rid of a lot of the headaches at the same time.
I think we're all looking for that sweet spot and those lack of headaches. They are not easy to find. Thank you very much for pointing them out to us, Keith Springer.
Thanks for having me back.